Well, hello there, everybody, and welcome to Henley Business School. We hope that you are very, very well on this Monday afternoon. You are joining us today, both in Johannesburg as well as in the Henley, UK. And we have back with us today one of the stars from the first SME sessions, Norbert Morovich. Norbert, you are so welcome. So nice to have you back. Please, will you bring your sound up as well? No, but we can see you, but we haven't got sound for you. Please, will you unmute yourself? All right, I think we'll get our tech team in the background to see if they can unmute Norbert for us. And while we do that, I'll let you know that this is our very last week of the current series of SME sessions. And what we'll do this week with Norbert is to revisit the theme of building a digital business as a non-techie. And Norbert is going to take us through two sessions, one this afternoon, and we'll start with that session now, and then another session on Thursday afternoon. So Norbert, welcome back. How are you doing and how are things in the UK at the moment?
Yeah, hello. Hi, Luis. Very, very good to see you. You're looking fabulous, as always. Very good to see you. Yeah, things in the UK are good, interesting times at the moment. You might have seen on the news, we're also having, of course, still a little bit of Corona going on, but also demonstrations on the street here as well, sort of coming over from the US. So a lot of debate going on, interesting times.
Yes, indeed. Very, very dynamic times on this. I don't think anybody that started 2020 expected this particular year. And I think it is indeed a time to stand up for what matters in many ways. So Norbert, absolutely, we have these two sessions, a session today and a session on Thursday. And we want to treat them in a very particular way. Won't you share with us what your thoughts are on the approach that you would want to take with us today, and then how you want the session to go on Thursday, because that has a very particular flavor, and I heard you use the words talk radio, I believe.
Yes, yeah. So I mean, today I think we're gonna do a little bit more traditional format, sort of on the line along the lines that we have already that you're very well versed to. But for Thursday, I really want to make this a very open and free session in a way, and really try to answer any questions that you have. And we've prepared a little form that I think we'll be sharing as well, where you can submit your own case studies or questions, and then possibly also decide whether you want to come and join us live on air, maybe present yourself, or you can send your ideas in and we'll talk you through this like a live business clinic talk radio show in a way. So that's what we'll hopefully want to do on Thursday, which should be good.
Fantastic. So if you want your business to be a case study, if you want to share some ideas, and I must tell you, but since we've started this journey, I've actually hatched some ideas as a non-techie for a tech-enabled business. So not a tech business, but a tech-enabled business. And I think what you shared with us in the first session, as well as some of the other people that we've had on, has had a massive influence in my sense of confidence that this is possible and that this can be done. So I'm really excited to listen to you today. I'm going to hand over to you in your very capable hands. Please take us away.
Okay, well, Luis, of course, it would be fantastic to have you through your own ideas on Thursday. And maybe, I don't know how much you can share.
I can do that.
Maybe you can make it as abstract as you want. But yeah, maybe we can talk through this as well. Would be quite exciting.
Patrick, I'd like to do that. Thank you. I'll take you up on your offer and then also share with some of the amazing people that we've had on this journey with us. I know you've done this before, participants, people, community that has been on this journey with us. But as always, if you would let us know that you're here, what's on your mind, please check in with us on the Q&A, and then we'll make it interactive. We'll make it conversational. Norbert he really is a bit of a maverick. He has a wonderful mind, and I challenge you today to come up with some questions that makes him think. That's my challenge to you today. And not just those, just the ones that you're curious about.
And of course, I think we're also always joining here really, Luis, because we want to see you dance at the end.
Absolutely. Thank you.
Yeah. Okay. All right. So then shall we make a start?
Let's go.
Let's see. Whoops. Does that work? Yes. Can you see my screen?
I can see your presentation. It's not in presentation mode just yet. There we go. Perfect.
Perfect. Okay. So today then, as a session, as a somewhat slightly more specialist follow-up to the other two sessions. So first session was very broad around business models to some degree. The second was very practical. Today is a little bit of a mixture. Here there are so many topics to talk about. So today I think what I want to pick out is a little bit more some of the financial side in a way, which harks back a bit to business models as well to some degree though. We're gonna do the same thing with the pink slide thing as well again. So I'm gonna open up for any questions that you have throughout. And then of course, Thursday's session will be entirely around that. But if I wanna just sort of like jump straight in, and I know we're running a little bit behind of time as well. So I'm gonna try to catch up with that. Let's start with a traditional tech business here. Let's start with a big tech business. Let's start with Tesla. And yeah, so I mean, this chart shows us in a way what the revenue for Tesla looks like over the last 10 years in a way. So in this case, we've got 12 quarters here. And it's quite interesting to sort of like, if we look at this over the longer horizon as well, that Tesla has only ever made a profit in 1 out of 40 quarters. So its 10-year history, it never turned a profit. I can see sort of there in the third quarter of 2016, they very briefly once made a tiny bit of profit, but in all of the other years, they have, of course, turned a significant loss, as they will to some degree also last year and this year. So they've always lost a ton of money. But if you followed the Tesla stock valuation, then of course you know that this is being treated as, would it be as a gold mine, as a money printing machine, as maybe as a company that generates a lot of profit. And despite sort of never having made a profit, it is obviously one of the best funded companies out there. And so maybe to start off with, I guess when we talk about finance and business models, we could ask if sort of like basic economics effectively don't apply to startups. And that's kind of like maybe the key question that I want to use to explore this topic of startup finance a little bit. Sort of like if I ask you to sort of look at these two companies. So here's a company on the left-hand side, on the other side, and where you would prefer to invest your money, then of course everyone will say we want to invest our money into the company on the right-hand side, because obviously that's where the growth story is, right? So that's where you want to invest your money. You want to invest your money where the growth story is, where you're coming out of a loss making and you're growing into generating very big revenues and profits down the line. So that the problem with a startup and also with a tech startup is that when you look at this from an investor's perspective, you don't have 5 or 6 years of history that can show you this growth trajectory. But most people, when they start their business, they don't have that financial history. So you're on year 1 here, and all you can show your investors is we're losing a lot of money. So please give us a lot of money, because we're going to make a lot of money in the future. And so if we take a bit the Tesla story here, what does that tell us? It tells us that obviously there must be a lot of people out there for whom there is this sort of thing called the overwhelming importance of future revenues, right? So from an investor's point of view, they don't almost care how much you've lost in the last year. They won't care about that, and they won't care about how much you made last year. What they care about is how much will you make in the future. And certainly when we talk about all of those big tech companies that are out there, they have lost tremendous amounts of money in the first couple of years. And as a standard or a retail investor, you might be a little bit more critical about this, but as an investor in startups, you know this stuff. And there really the view is that a company might take somewhere between 10 or 20 years to really grow into its real value position. Maybe, as we see with some of those tech companies now, it might take 20 or 30 years to actually really grow into the company that they ultimately want to be. So it takes a while to generate something valuable, and it's also perfectly okay to lose money in the first couple of years. In the same way as sometimes we talk about first mover advantages. So when companies move into a new space, but actually what seems to matter more is last mover advantages. So who's the last person into a market and then sort of take advantage of it. And so now you're going to say, okay, well, that's really great. So there's all these big tech companies and somebody has given them the money to grow into those big companies, and the US sort of venture capital model, and certainly also a little bit the UK capital model, really looks like at this and saying, well, you know what, if you need 20 million that you can lose for the first 3 years, that's fine. Let's write you a check for 20 million. So the question is, of course, what's the reality check for us here? Where can we find those investors that give us money to lose money for the first couple of years? How can we build tech companies if we don't have access to this kind of money, right? So that's kind of like the flip side of this one. On the one hand side, very well established. If you want to grow any of those successful tech companies, you will have to burn through money and not necessarily prioritize profits. But on the other hand, who's going to finance that? And so maybe just to recap again, and let's look at sort of what a traditional financing model looks like here. And I can't hear any one of you, can't hear you, so I'm just going to check for the moment that everyone is still there. Yeah, okay, I can see Luis. Great, just move that back in again, just to see that I haven't lost all of you yet. And sort of like, if I look at this traditional model of what startup funding looks like, then kind of like a key point here to make for founding a tech business or any kind of other business where you first have to spend a lot of money or some money and then kind of like have to grow it a little bit bigger and maybe have to spend a bit more before you can really make a good return on that, or before you can really start to monetize it and build revenues. And that's kind of like how this kind of like startup funding models are built. And they are really built around stages. So different stages that you should aim towards with achieving funding. And to start off with, if you haven't really got anything going apart from maybe a good idea, you're at this idea stage and you might say, okay, I need a little bit of money to get going, but what is it really that you need to control here? You don't necessarily need to control financial resources, but you need to get some human resources to get you going. And maybe a different way to look at this at the startup stage, very first start stage, is really, especially if you want to build a web application or a website or any of those things, you might need some development resource. And if your option is to say, okay, I just have this idea, I have to find some investor for it, I might need, I don't know, let's keep it in dollars, I might need $50,000 or $20,000 to build this website. You can find an investor, or you can find a co-founder, a technical partner, and say, you know what, I could pay you $20,000, or you could become a co-founder and I'm going to give you a bit of percentage in my business, and you join me as a co-founder here on my business. I give you 5% equity, and you do a shareholder agreement, which includes a vesting clause. So that means that if they don't do their share, or if they exit the business prematurely, you get the shareholding back. So there's ways of contractually organizing this in a very cheap way, in a way to make sure that people do commit. But that's kind of like at the start. So let's say you got over this stage, you start to build something. Typically you would tap friends and family, maybe the government. You go and you raise a seed round, and eventually, with the most successful companies that we look at, they would go and raise something called venture capital funding. Okay, so that's kind of like the traditional model. And the important thing to say here on this is really always to look at what is it that we're starting, and also what is it that we're eventually going to look like to exit. So how are you going to leave the business that you're building? And that's kind of like that's an important question to ask, even at the very early stages of this business, because that really depends on whether you can pull this off or not. If you want to build a lifestyle business where you can be your own boss, maybe don't have to answer to many other people, and where effectively you want to stay in control and run this business forever, then you're building a lifestyle business. Most tech businesses, they have to at some points sort of go the other direction. They have to go down the empire building route. So they have to enter scalable startup territory. And what does that mean? Sort of like on the scalable startup territory, it means that you're trying to grow a bigger business, which means you will have to take external funding. There is just no way around it. At some point, you might have to take in external funding. And if you bring in external funding, it means that you have investors, it means that you have to partially report to those investors. And at that point, whenever somebody puts money into a business, they want to get their money back, and I want to have a return on this as well. So at that point, the logic of the business becomes a different one. So at that point where you've taken the investment, the logic of your business has to be, to some degree, how do I give my investors the money back? Which means growing and possibly selling the business at some point, or going onto the stock exchange. Now that might seem really abstract and far away for you at the moment, but that's kind of like what you have to consider from an early point of view. And my assumption is that from a South African standpoint, you're probably looking over to the UK and to the US, and you're thinking, okay, those guys have got a ton of finance available and lots of opportunities where they can find different financing sources. But it's worthwhile to sort of like just briefly look at what sort of the statistics look like, and kind of like look at who invests into new companies and tech companies and startups in a way. And so you can see sort of like over there in the top left corner, the majority of founders effectively, they don't get any help from anyone, right? So even in the UK, it's even worse. These are statistics for the US, but even in the US, in the land of plentiful startup finance, about 57%, nearly 60% of startups are founded effectively by the founder, which means that they have to save up a bit to sort of get themselves going, and they have to take the risk and invest in it, right? So there's just no, in some ways, there's just no way around this. You kind of like have to, the first bit is the hardest bit. You have to somehow scrape the money together, either through your own work, maybe getting a co-founder, or friends and family, right? So that's just unfortunately how it is in most parts of the world. In some European countries, we're very fortunate. So if I take, for example, in Sweden, right? If you want to start a business in Sweden, the government will pay you 6 or 12 months the equivalent of your last salary to start your business, and there is ample funding available. Same in Austria or in Switzerland. If you want to do a business there, you will have access to very generous grant funding to get you going. But for the majority of the world, and I assume that's the same case in South Africa or possibly worse, finding finance is always a tricky part, and there's almost no way around it. But kind of like getting there by yourself. If you go to that next stage, angel investor stage, again, I'm not too familiar with what the what it sort of looks like. In South Africa, angel investor side in the UK is of course excellent. Here's a lot of government legislation in the UK that benefits investors to invest into startups, very generous tax credits, and some of these funds are also, as far as I know, investing abroad and into South Africa. So there's a little bit of an opportunity, especially to UK-based finance funds here as well, angel funds. And when we talk about venture capital, you can see only 0.5% of companies ever receive this magical venture capital funding, in which the average amount invested, you can see here, 6 million. Wow, that's a good number, right? That's a good amount of money, but only very few companies ever receive that. But those companies that receive it, some of them become very big and very successful. So just a quick overview here of our different financing options in a way, how it goes through. And maybe I'll pause here for the moment and see if there are any questions, but maybe to sort of sum up first observation, maybe when we look at startup finance, the first really important point when you start to think about your startup is, and you maybe start drawing up a business plan. Look at your business plan, and if it means that on your business plan or on your spreadsheet forecast, in a way, you're losing money in the first 2, maybe 3 years, you're in good company. That's what a tech startup might look like. And we also know there are investors out there who back these kind of companies. They are geographically maybe a little bit more dispersed in the world, but there are people out there. And kind of like the counter side to that is, in order to be able to access this later stage of finances, most founders, unfortunately, they do have to back themselves. Okay, I'm quickly gonna have a look here on some of the questions, to see if there's any kind of like questions coming through. Or I don't know, Luis, are there any questions coming through?
Hi, Norbert. So
Hi.
we have got a couple of questions that are coming through. Tommy asks, is there such a thing as non-resource funding, or is it a myth?
Non-resource funding, as in, maybe Tommy can elaborate a little bit more. There is funding there is funding where you don't have to give anything for it. Yeah, so there's grant funding.
Sorry, it's non-recourse funding. I think it seems Does that make sense? Do we need information?
I might need a little bit more explanation. How I interpret this at the moment is funding where you don't have to give anything in return. So grant funding where maybe you just provide it with free funding where you don't have to give any shares away, or on crowdfunding platforms, rewards-based crowdfunding platforms where somebody might want to support your idea, but you don't have to give them a stake in the business. Yes, these kind of funding sources, there are out there, especially on the crowdfunding site. So you might be familiar with Kickstarter, but there are a number of other crowdfunding platforms which are rewards-based crowdfunding platforms, as opposites sort of like equity platforms. And yeah, these platforms are open also for people all over the world. So you might go and apply definitely also to some of the UK versions of those platforms. And they tend to work quite well with consumer products or products where there is or ideas, business ideas that have a social impact remit in a way. So I think I will honestly have to say, so far, my impression is that African companies have not really taken advantage to some degree to willingness of also Western consumer investors in a way to back these kind of businesses. So there's good opportunity to tap into those markets as well, where people would be quite happy to back also startups from abroad or back ideas from abroad if you can put a video and a pitch together and sort of use those platforms, just to sort of follow up. So that's maybe something that's been underexploited so far.
Thank you. Tommy says that's what he was talking about. Thank you. Shane Peterson says that the lowest percentage of startups are invested by VCs. Is there any correlation between the source of finance and success of the startup? If this is so, the ratio of wildly successful ideas is likely to be 1 of 100. What are your thoughts on that perspective?
Oh yeah, absolutely. I mean, 1 out of 100 hits it on the successful idea front. If I jump back here, this is also where we see, in a way, a watershed or a division between startups that are, or companies where we may be a little bit more on the lifestyle side of things. So a smaller medium-sized business might not have a need for such high amounts of outside capital as well. But if we're looking at the 0.5% over there, it's a very small amount. It's a very small amount. And this reflects 2 things. The first maybe reflects that there are not that many good ideas out there, right? So if you've got a good idea, it's very likely that you will get the funding for it. And that's sort of like the next thing that I really want to talk about in this sort of journey. So there's 2 ways of looking at this. Very few people get this kind of money, but obviously some of them do. So kind of like the next thing that we need to ask ourselves is, what makes a good idea, or what are those VC investors looking for that they are willing to throw money at some ideas, and how do they do that? I did a bit of research before looking at sort of like what the private equity and venture capital market in South Africa and also in Africa generally looks like. It is growing. There is a lot more work to be done. But again, there's plenty of opportunity also for entrepreneurs or just maybe people out of finance with an entrepreneurial mindset to do a lot more, maybe bring in capital also that and sort of connects from the outside world. So there's a lot of work that can be done around that, and maybe an interesting topic to sort of talk again in a few moments. Maybe if I move on at this point and pick this up again in a few minutes, if that's okay. So
thank you so much.
Let's sort of like continuing on that sort of question and path in a way, which has been a really nice segue for me. I don't have time to play you this video. It's a really good one, but effectively, like with everything, there's a bit of a hierarchy, right? So and also with venture capital companies, you've got this whole pyramid of who sits at the top and who sits in the middle and who is kind of like at the bottom of the venture capital companies as well. So you've got those 0.5% of companies that get funding, and on the other hand, even within the venture capital world, you've got the hierarchy as well. Again, with at the top some very mightily successful venture capital companies who invest in all of the top companies. Then sort of like a middle tier of companies that are a little bit more open to other opportunities, and below that specialist funds that are looking for returns and might have also other investment criteria, or might be a little bit more lenient on where they're investing. to my knowledge, kind of like one of the best books on this subject. If you're interested in this, a book called 0 to 1 by Peter Thiel, who's a divisive figure. Let's call him a divisive figure, a very successful venture capitalist, one of the first, one of the co-founders of PayPal, made a lot of money, took all of that money, was one of the first investors into Facebook, times X'd his money, put his money into some of the other most successful companies out there. So hugely successful investor. On the flip side, he's always been a contrarian, so he's also very divisive for having been and still remaining sort of like the first big Silicon Valley guy to be on Trump's economic committee. He funded a hugely controversial lawsuit in the US to shut down Gawker Media, which caused a lot of outroar. So a strange billionaire, may we say, but on his core subject of venture capitalism, he's spot on and incredibly lucid. So that's kind of a bit of a book, a recommendation if you can get around some of the baggage that the man brings in other areas of his life than on his investment logic and explanation. He's very, very cogent. So yeah, but you have to get around the other stuff. But sort of like in this book and sort of like talking us through this, he's kind of like explaining how venture capitalists think. What are they looking for effectively? And what they're looking for are early stage companies that can return a lot of money. And how are they going about finding those ideas? So they only want to invest, typically, at least at the top end, they only want to invest in companies that can return 10 times the investment, at least, right? So the minimum requirement is that they could return 10 times the investment as a return for the investor. And if you sort of like, a typical logic would be that maybe you would think that it makes sense if you have got a fund. So how venture capital, how it will work typically is that they themselves raise money from a wealthy individual and they pool this money into a fund, and that fund might be 50 million, 100 million, or if we're looking at some of the US funds, there might be 1 billion or 2 billion or more, right? And that's the kind of money that they have under management. And then they have to invest this 50 million, 100 million, 1 billion, and they have to invest this money into startups. That's the remit that they have been given by their investors. And then they go through business plans and they look at ideas. Where could they invest? Where could they invest this kind of money? And they're not looking for companies that could give them a 2 times or a 4 times return, which we would say are good companies, right? If I'm starting a company today and you're saying, okay, I need 100,000, you're starting a company tomorrow, you're saying, okay, I need $100,000 and I'm going to give you back $200,000 or $400,000, so a 2x or 4x return, then I'd be probably quite happy. I mean, fantastic. You've given me a fantastic return. But those venture capital companies, they are looking for 10 times the return. And they only want to invest in ideas that have, in theory, the potential to return this 10 times return, right? You don't have to demonstrate it yet, but the idea needs to have the potential to return 10 times. And why do they do this? They do this because the success of companies doesn't follow what's called kind of like a normal distribution. So when they invest in a portfolio of companies, and typically that number actually tends to be around 10 or 12 companies. So they might invest, if it's a 100 million fund or 50 million fund, they want to invest typically in a number of 10 to 15 companies, right? So that means the bigger the fund, the more money they have to get rid of with every check that they write. But they are looking for not a mix of companies in their portfolio. They want every company in that portfolio to be able to outperform and succeed. And the underlying thing here is something called the power law. Power law means that there's a chart here missing. Power law effectively means that how investment returns are distributed, it means that typically 10 or 20% of your investments return 80% of the entire value of a fund. So they are just looking for one company out of 15 companies typically generates more money than all the other 14 together. Yeah. So that's kind of like how this blockbuster investing works, and how at the top end, also when we look at how these top companies and how successful they are, it's the one company at the top that generates more money than all the other companies together. So they want to invest into a mix of companies that each could be the big thing. And maybe, although the graphs are missing, maybe just to sort of show you a little bit the other flip side of this logic, right? So people might know Instagram. Instagram was bought by Facebook for $1 billion in 2012. And for the venture capital company that invested in Instagram, that was a good return. They made 312 times their money, and they netted close to $80 million, right? But for the fund itself, this deal was a catastrophe. Why is it a catastrophe? Because the fund is 1.5 billion, and they only wrote Instagram a check for $250,000, and that doesn't work, right? Because in order to sort of like just return the fund to the investors without having to without making any profit, they would have to find 20 of those extraordinary deals. So these funds, believe it or not, they have a strong mission, and in a way a strong logic to write you very big checks. They want to get rid of their money, and they want to write checks which are really in the size of the order of $1 million plus. So 1 to 5 to 10 million. They want to write big checks, and they want to get rid of the money. And one of the clear things here is that it's really hard to understand in a way is that for a venture capital fund, it takes the same amount of money to invest $50,000 into your company and to do all the checks on your company as it takes to do checks on a slightly bigger company where they can invest 500,000 or 5 million. And so that it kind of like takes the same amount of time for them, and they would very much rather prefer to write a bigger check. So many venture capital companies, if you go and speak to them, don't ask for too little money. They have got money that they need to get rid of. That's the logic. They can't sit on the money. They need to return the money. So they need to write big checks. So that's kind of like the flip side of the equation here. There are people out there who wanna and kind of like must invest large sums of money. The problem is how to find them to some degree, and also to some ways, how can we build business models in a way that look like they will attract this kind of funding, and how can you think about that? And that's maybe the final part of this sort of like short lecture here, but I'm gonna see again before we go into this next topic whether there are any questions.
We do know, but we have some questions. So William wants to know, any advice on bootstrapping and joining a startup incubator? What are the dangers of following this path?
Oh, an excellent question. So for those of you who might not necessarily be too familiar with this, tech accelerators have become a very big part of the sort of like entrepreneurial ecosystem, and depends of course what this tech accelerator offers to you. Very often sort of the standard offering looks at giving you some office space and a program that might run from 3 weeks to 9 months at the other end of the spectrum, typically probably somewhere between 3 and 6 months of a program. So office space plus business acceleration support, which means maybe giving you a bit of seed financing and also opening networks and doors for you. And in exchange for that, most tech accelerator programs will ask for a share in your business, and that is typically, I would say, also in the range of somewhere between 4 and 7, sometimes 10, could go up to 15% of the business. And that's of course where you have to really be quite careful in terms of like how much you give away. There is again a little bit of there's a bit of a hierarchy again in terms of like what are the best tech accelerator programs to be in. There's really only two things I would say you have to look out for. First of all, make sure you get a fair deal. I think up to 7%, giving away up to 7% at a very early stage for a good tech accelerator program absolutely makes sense. If they ask for more, I think you have to be sure that you get the value. You have to get the value if it's more than that. The other side is, and that's also from our own experience of going through a tech accelerator program, that is really how ready are you as a business to go through this acceleration process. If the accelerator program is very good, then one of the key values that you should get out of it is a lot more networks and promotion to potential customers, whether that's on the consumer side or on the business side. So they should be able to open doors for you and really enable fast growth by opening these kind of doors. But then on the flip side, the necessity here really is the readiness of your business to take advantage of that. And this comes in two forms. On the one side, if you're doing a tech business, of course, the technology needs to be in some sort of minimal state already in order for you to truly take advantage of this offering. So if you do not have anything yet, and you're going into there's some very early stage accelerator programs, but most of the accelerator programs, you can only really take advantage of them if you have got some product that they can then also promote and open doors for you. Otherwise, you will not see necessarily a big market acceleration process there. The second is kind of like a human capacity point in terms of like what if I was using a business school term, what kind of like your absorptive capacity is to handle this kind of accelerator programs. So if you do decide to join an accelerator program, make sure you have got a co-founder or bring in people relatively early to help you take advantage of those networks, have enough boots on the ground to follow up all of this acceleration program. Because there are companies now who do tech accelerators, and we've seen this certainly in the UK and in the US. So some companies do a number of tech accelerator programs, so they do one and another one and another one, but really you only want to do it once, and you want to be ready for it so that you can really make the most out of it. That's kind of like the ideal view of this. Apart from that, if that particular accelerator program that you're looking for offers you some seed funding, if you're in desperate need of seed funding, if you don't necessarily know what you need to do, definitely also just apply and see if you can get in and try to take best advantage as you can, although you probably won't get as much out of it as if you were a little bit further down the line. Ultimately, the biggest value around tech accelerator programs is always to do with the other groups of startups that are going through with you through this acceleration process. So I would, with any kind of formal program, to some degree, it's the same with a business, with doing any kind of business degree or MBA, as well as a business school. The most ultimate immaterial value that you get any of those programs is always the group of people that go with you through the same experience, learn the same things, help you in your own learning process, and accelerate you in this way. And certainly on a tech accelerator program, getting sort of the other companies to help you who might be a little bit further down the way in other ways than you, and you maybe in other ways to them, that's ultimately where the strongest value is. So when you evaluate which accelerator to join, make sure you join one that has attracts other strong companies, because that's where you're gonna really have the benefit. In the same way as if I want to plug our good old Henley brand here in a way, if you go to a business school, for example, if you doing anything with Henley in South Africa, you know it attracts good people, and there will be a lot of good learning coming through the cohort, and a lot of good networks, and that's ultimately in some ways also the case with this accelerated program. So it's not just the program, it's the people that participate in it.
It's so interesting. Chris Adams says, just a comment, it's better to own the back leg of an elephant than half a goat. But it is difficult to decide to get involved in, right? Chris, I believe you started something recently, so perhaps you want to consider bringing that to our forum on Thursday. Let us know what you think about that. And then there are a couple more questions, and I don't know if you want to take those now, or if you want to continue a little bit, Norbert. We're at about 10 to the hour now.
I don't know how good those questions are. I'm curious about those questions to some degree.
Let's share them. So Sarah says, can you please share the names of the funders that fund ideas that have social impact? Perhaps even just point us in the right direction here.
Yeah, okay. All right, I'll take that at the end. I've made a note. Anyone that's specific on otherwise I'll quickly do another 5-10 minutes or something, and then I'll go back to all of those questions. Was there another one question now?
There is only one more, and that's from Alden Pukwile. He says, where can we get information on how to address the challenge where we are the co-founders that have an idea but not technical? Now, Alden, I want to say that in the very first series of SME sessions, we had Norbert talk about how to start a digital business as a non-techie. So that might be one webinar that you want to go and look up. That is on our website. But Norbert, is there anything that you would like to add there now, or perhaps a little bit later?
I'll pick this up again at the end. You know, the whole topic of co-founding, how to pick a co-founder, and also how to distribute the equity to different co-founders is a really interesting one. Yeah, maybe we won't have time to go too much into detail today, but I might at the end of the session just throw up a different slide quickly to talk this through very quickly, sort of like this problem.
Lovely, thank you.
Okay. So then you might remember from one of the previous sessions as well, we spoke about sort of the unicorn startups and the cockroach startups on sort of the other side, and different paths to grow a company. For most companies out there, in a way, this really also sort of like translates to some degree when you talk about finance, right? So most people, including myself, is sort of sitting on the right side over here. When we're growing a company, what matters is that maybe you get some reference customers really quickly, you get some testimonials quickly, and you get some sales. And I'm sure Jurek will have hammered home the importance of sales plentiful over the last couple of sessions, and partnerships. So that's sort of like what we would typically be looking for. Also, if you want to find a traditional investor, that's what they would be looking for to some degree. It's worthwhile noting that if you're aiming towards building venture capital or attracting venture capital funding, you might not need any of those things. You might be looking at trying to generate a very different set of metrics in a way. And very often venture capitalists or sort of more risk-friendly investors, they will ask for metrics, and then they have got a couple of metrics that they want to talk about. And we could do a whole session just on what this kind of people are looking for when they talk about metrics. But typically they will be looking at things like user growth on your platform. They might be looking at monthly impressions. They might be looking at something which is called cohort analysis. So that's how often people are coming back, how often users are coming back to your platform on a daily, on a weekly, on a monthly basis. And I've seen a number of startups raise very significant amounts of money with no sales income, but more or less a fancy printout of their Google Analytics sheet where they were able to show that a small group of people, and when I say a small group of people, we can talk as low as 100 or 200 people, are coming back and using a tool or a product or a service on an ongoing basis, right? And so they take a very small sample. It can be a very small sample. It doesn't have to be a big amount of users. Just saying, okay, here are some people that use whatever product service you're offering on a repeat basis. Please give us a big amount of money so we can scale this up and make it available to lots of people. So they might not necessarily look at sales, and you don't even have to attempt to sell anything yet. They are looking for engagement. A little bit further down the line, and that's the same with another metric that they might look at is effectively hype. Yeah, how much hype have you been able to generate for your startup? Might be that you don't even have a product yet, but you might already have a big social media following or other ways. So that might be another interesting metric for the investor side. In some ways, if you're looking at this from a traditional point of view, it's like, oh, this is a bullshit metric. What is this about? But on the sort of high finance side, this is a serious metric. And then sort of the other things that we're looking at here really when it comes to sales, something called MRR, so monthly recurring revenue, or ARR, annual recurring revenue, right? So there's a whole different lingo that venture capitalists or investors are adopting to talk more about the same things that we also talk about, but you have to talk to them in their own language so that they know they're talking to someone who's in the know, but nothing complicated about this. And what does this come down to? In a way, it comes down to scale, and it comes down to scale. Jumping ahead here a bit, I think I want to go back to the question, so I don't want to spend too much time on this, but I think especially for anyone who is in the fortunate position as you are at the moment to be in the fastest growing continent on this planet, you have got a massively good story to tell about a growth market and an underserved market, right? So I wouldn't underestimate the very fortunate position that anyone is in South Africa at the moment to have a vast market domestically, but also across the continent ahead, where you can legitimately claim, if you're thinking Pan-African or globally, that there's a vast, often underserved market out there that we can go after. That's something that that is a huge asset if you're trying to raise money. So, and it also should make it in theory much easier for you to raise money if you tell this story in a clever way. But then just to brief this off, and the slides believe will be shared afterwards anyway, so you can have a look at this. This is more or less copied over from a very good TechCrunch post, and we're looking at different kind of business models here that can generate and grow to a 10 million revenue. 10 million here is completely arbitrary to some degree, and you might be very happy to grow a business that generates $100,000 a year in revenue, or might generate 200,000 or $1 million. Okay, that's not the point here. I think the point here with the 10 million is that once we consider a business right from the start as a business model, in terms of business model, what would it take to grow a business into this winning category? And that's also what you will have to answer if you talk, and if you're looking for big finance or for bigger finance. People want to know, how can you scale your business model into those big realms? And that's kind of like what this kind of thing does here. It unpacks a number of the most classical digital business models in a way, and looks at what are the unique growth drivers in each of those business models. And so if we take the simplest one in a way, which is to sell something online, then of course, sort of what are key metrics here? If you're doing this online, you want to have some customers. In this case, if you want to get to 10 million, you probably have to have 4 million people coming to your website. Out of those 4 million people, 10%, typically these are industry averages, will buy something on your platform. If they buy something for $50, gives you 20 million in revenue. In this case, assumed whatever you're selling, cost of sales is 50%. So that would give you 10 million in revenue. And industry standard, again, there is also charts out there which look at specific industries, what the average marketing spend in the industry is. But average sort of for an internet startup would be that whatever revenue they make, they're generating or throwing 30% of that revenue back into the business, into growth, right? So they could stop at any moment, but because we're in growth-oriented businesses, typically 30% gets reinvested into growth again. So that's simple to some degree. This is what we're looking at in terms of like selling something. Marketplaces, from your eBay to Etsy to Airbnb, they typically follow a slightly different model. There we're looking at listing fees, and you can see sort of like, unfortunately, we don't have the time to really run a spreadsheet session here with you, where we sort of like also built this on our own spreadsheets and model this kind of stuff. But just to kind of like identify a little bit the key drivers of these digital business models, you can see how the numbers play out, right? So if you wanted to build a profitable marketplace that works on where people list some stuff, and you take a small commission fee if something gets sold, and maybe there's a small listing fee, you have to have a significant number of people coming in to generate a lot of revenue. But you wouldn't have to demonstrate this with a lot of people. You could demonstrate this with, you could demonstrate such a business model with having maybe 1,000 people listing something on your marketplace and generating a small amount of money. But once you've done that, you can go to a venture capital company and say, this is how it works in principle. If I had the marketing dollar to grow this up, I can grow this across South Africa and grow this elsewhere, and I can make this money. So it's about demonstrating these kind of business models along those lines in a small way, and then scaling it up. And maybe as the last one, before we look a little bit more into those questions, is a subscription model. And again, investors might not look for much sophistication to start off with in your models, but anything that looks at subscription models, which tend to be a very popular business model, digital business model, what they want to see probably is something to do around churn rate, and something around customer lifetime value. And what does that mean? So that means, what's the churn rate? The churn rate basically means the rate at which customers stop being your customers, right? So whatever you offer, whatever service you're offering as a subscription model, typically a small percentage of your users, or it might be a high one as well, will stop using your service. They will stop subscribing after a period of time. And that period of time that they stay with you is called the customer lifetime value, or LTV, which is typically measured in months. And so the most interesting thing that you can offer an investor is to give them an idea of what your churn rate is, so how many customers are dropping off, and also give them an idea of what the customer lifetime value is. So how long do people stay with you? Because if they know those two things, it's very predictable for them to throw that into their own financial models and work out where your business stands and how it can grow. So those are kind of like the key things that, from a digital business model point of view, that investors really would like to consider. They want to know what the LTV is. They want to know a little bit what the churn rate is. Might be that you're just assuming it, but if you can put something, even a simple spreadsheet in front of them that models these things, it goes a long way in terms of like modeling and giving them assurance for you. Okay, so this would be a last one, I guess, looking at social media ones, and in a way that's the same for any kind of advertisement related business, where effectively you're offering something for free. Means on your website, might be whatever you might want to offer. You create a social network where people come together, and because they come together and they're offering that for free, people come in, they look at if it's a forum that you're running. If it's a forum, they're looking at different sites of the forum, and every page of your web application or mobile application or forum or whatever you're running there in terms of your social network, every time they look at something, it's a page view, it's an impression, and there could be an advertisement on that, right? So in this kind of model, typically then you have a number of people, they look every month, ever so often on your app or this sort of things. And each one of those could be an ad that you could have sold. So that's kind of like your whole inventory. On the flip side, you have to sell this advertisement inventory to other people. If you don't have any links to that, there are things like ad networks that you can plug in automatically, and they will start paying you from day one. So you don't have to go out and find companies that want to advertise yourself. They are out there as well. So you just plug one of those things in, and then it's effectively just growing into more companies. Look, I'm looking at the clock here as well. So I think I'm going to stop here. I'm going to stop here. I'm not going to talk through gaming, although it is such a good business, unless anyone wants to talk about gaming.
Thank you. I'm sure people will tell us in a moment. Thanks so much, Norbert. Please, can I ask you to stop sharing your screen? Can we see all of you? And then if you'll pick up on those questions, and then also there's one more here from Zema. Hello, Zema, who says that the third bullet on the very first business model that you shared around logistics and fulfillment and so forth, she says it's so true. It is incredibly hard to deal with couriers and companies post-service. And she did ask if you could share the link to this particular TechCrunch article that takes us through the different business models, if that's available.
Absolutely, I will definitely do that. Okay, so then going back to some of those earlier questions. So the first one was around some of those impact funders and this sort of things. So I think on the crowdfunding side, there are a number of those. I can possibly also add that to the presentation as links that I'll share with you afterwards. Kickstarter, Indiegogo would be probably the two most popular ones in the UK at the moment, but there are also a smaller, more niche ones as well, especially around creative industries that are there. So those would be on the crowdfunding side. On the impact funder side, so these are venture capital companies that are also investing with a view towards making a social impact. There is a number of those angel networks and funds in the UK. And again, I might put some links together and add that to that. Beautiful. But yeah, but they're typically not too difficult to find as well, and they're quite open. So I've seen also in UK accelerator programs, there have been a number of startups from specifically looking to stuff in Africa. I think it's a major plus point if you want to also come here effectively to sort of like come and exploit the market to some degree. And on the other point was around co-founders. And remind me again what the question was around that, I guess.
Oh,
so I think it was around, if I remember it correctly, sort of the question here was around how can we bring co-founders on board what if they don't have the right skills, or if they don't have technical skills. I don't know, might have noted it down incorrectly.
I'm finding the comment here. It was Alden, and he said, where can we get information on how to address the challenges where we are the co-founders and have an idea but are not technical? So it sounds like these are co-founders that are not technical, have an idea and want to mission. And this is very much what your first podcast dealt with, I think.
Mm-hmm. Yeah. So if you, so this sounds to me that you are part of a technical startup team where the founder is actually a technical person, and you are the business co-founder to some degree. And so that the question here is really who drives the innovation to some degree. So is this a company that's very much driven by the technical co-founder in terms of where he or she thinks I have an invention or I'm developing something that's going to be very useful in the market. And so I guess this is a classic topic for our Thursday session, on a talk radio session, so where we could ask some questions back as well. So that would be fantastic to answer that. But just to sort of like look at this a little bit, you could say, I mean, I don't, again, I would need to know a little bit more in terms of like what you're offering on this, on the business.
So Alden, the invitation is for yourself and your co-founder to join us on Thursday. Give us a little bit of information via the link that we shared on the Q&A, so that we know what we're working with, and come join us. Let's use your company as an example, as a case. And then let's talk through how we might make that happen. How does that sound? Let us know if you like that idea, and we can absolutely work with that.
But yeah, I mean, yes.
Yeah.
Working with technical co-founders.
In need of technical partners. This is a fantastic example, Alden, and it's not a quick answer. So how about we pick this up on Thursday? He says, great. If the partners like it, we will do it. Well, we look forward to seeing you on Thursday. Let's do it. I think we can all learn from that experience. Chris says the problem with adverts is that you want to get companies with the same ethics and ethos as your company, not, you only have one reputation. And we see this play out in very interesting ways in the world, as, for example, Facebook at the moment. All right. Dave Prentice says, okay, let me see. I've already registered my .africa domain in anticipation of possibly moving north of our borders. So that's a provocation on my side also. I plan on bringing some of my examples for us to work through, Norbert. So thank you, Dave. Can't wait for that. And then Sarah, by way of closing, says, thank you so much. Thank you, everybody, for joining us today. Phenomenal, as always, to have you with us. And as you say your goodbyes for today, and also in anticipation of our session for Thursday, I'm going to start to bring our closeout song up.
Excellent. Okay, bye, everyone. Thank you. Thanks, Luis.
You are ever so welcome. Well, it seems like I'm not able to share my video with you all today, but what I can share with you is the song. And where we are going today is back to Kenya. This might not surprise some of you, I think, who've come to know me. And we're going back to one of my favorite bands, because we are on our second to last session for this current installment, and they are Sauti Sol. And the song's name, I think, is not the song's name so much, but the song's lyrics are very, very appropriate for this particular session. So take a close listen. Thank you, Norbert.
I wanna be rich, I wanna be famous, I wanna have lots and lots of money. Soar above the clouds, I wanna be free, like Nelson Mandela. Stand tall like a pyramid, so courageous. No place I'd rather be. Oh na na na, oh na na na. There's no place I'd rather be. Oh na na na. Live and die in Africa. I wanna live and die in Africa. Live and die in Africa. Hey, live and die in Africa. Hey, I wanna freedom. I wanna be remembered. I wanna go down in history. Met my mama proud, the darker the berry, the sweeter the juice. Nasitoki nyumbani, moja mila mtumwa. Ain't no place I'd rather go. Ooh, no place I'd rather go. I live and die in Africa.